Hello and welcome to another live trading session. Today is Monday, September the 30th. It's been a little while since we did our last session, over a week probably. But that's the way it goes with the new strategy. It's very laid back, very easy going, and not very active. So if that's something you like, trading once per week maybe or less, then this strategy might be for you. I want to let you know that the name of the strategy has officially changed. It was a placeholder UOTS, but to better reflect the strategy goals, we've changed the name to 10Alpha strategy with a full trading plan and everything available in the Discord. But the reason we call it 10Alpha strategy is to emphasize the goal, which is to achieve over time 10% alpha over and above what market gives us. Obviously, that's not going to be every week or every month or anything but like that. But over time, that's the goal. When we look back, we want to see around 10% higher. And the way we're going to get that is twofold. Or one thing is that with the strategy, we can pretty much keep all of our net lick in SGOV or T-bill, collecting the free interest. So that's around, at the moment, I don't know, roughly, let's say 4%. And we need another 7% from the actual options. And we already talked about it before, but we'll talk about it a little bit more. But as you can see right now, we have cash available, so we are fine. We're not paying any interest to the broker for margin. And we are able to deploy 45K into which is pretty much the full net lick, almost, into the SGOV, collecting this interest. And then we're going to try and collect the difference with the option strategy, which is very simple. Now, one thing here to note, these put debit spreads are finally expiring today. They've been dragging on for over a month and bringing the account down as the market has been drifting up for the most part. So they screwed up numbers a little bit for the strategy itself. And this is the actual first cycle of the 10-alpha strategy that we did. We did one MES on the 29th of August and then another one on the 6th. This was when the VIX spiked and the market pulled back a little bit. We placed another one. We learned a little bit. We learned that we could actually place it a little bit in the money as opposed to out of the money and collect a little bit more money in the process. But I was able to close the second naked put on Friday on the 27th. Or actually, that was the first naked put, the original one. The other one was closed on the 17th for $12, and then on Friday for $125, which is $5. We closed the original one after rolling it. So just to give you an idea, if you're new to it, we opened on the original trade on the 29th, and then we rolled it a few times. As you can see here, every time we roll it, we add the credits here. So the total credits were 42.25. We did it 3 times. And so the market went down and we rolled it, and then the market drifted back up. And then on Friday, we exited the naked put. So that's it. The cycle is finished. Sometimes the cycle will have 2 trades. Sometimes we'll have 3 trades, depending on how far the market drops down and how far the VIX spikes. But we are turning the page now with a new cycle. And one thing I want to do, I was keeping track here, but the problem here is and on the right hand side you can see the graph. It's pretty flat with the market just slightly better here at on one Friday. I only do it on Fridays. Number crunching. But the thing is, this was with all of those PDSs slowly bleeding money, so they kind of skewed the results. So what I want to do is I'm going to go to the old performance that we keep track, because we're going to continue keeping track of the account over the last couple of years. But we also do want to isolate the strategy, the 10 Alpha by itself. So on the 27th September is the last day here. We're going to start here fresh with today's date and remove these numbers just so we have the completely clear picture of what the strategy is doing. So today date is the 30th of September. Our net lick right here, we have to take a look here real quick. 48,035, 48,035, 48,035. And then the SPY is 57163, 57163, 57163. Okay, so that's a starting point. We index everything to 100 so that we can then keep track of these numbers, even if we add some money or we take some money out of the account. And so that's on that. So we're going to go ahead here and to start the cycle, we simply go to the MES right here. Let's take a note of the VIX, which is right around average, 17, 17, that's like right there on an average VIX. So our default is 65 delta. So we go here, trade, and then we want to keep it under a week. And today is Monday, so I don't want to go past Friday. So, we could do it just once a week, maybe do it on Fridays. Kind of depends on the liquidity as well. If we have more liquid strikes, maybe on Thursday or Wednesday, we can do that. But we can go here to Friday and take a look at around 65 and see where we're at. We have some open interest here at this strike, but that's 62. Let's see if we go a little bit higher. So as you can note here, the max profit here is 300. Now that includes both the intrinsic value, should the market pull up to our strike or past our strike, as well as this extrinsic value. Now this extrinsic value is guaranteed. We are getting that regardless of whether the market goes up, down, or sideways. We are getting that over the next 4 days if we take this strike. And so this is basically how how we are able to hopefully achieve about the same market performance with this always on naked put before adding the additional ones when the market when the VIX spikes and the market goes down. And we're hoping to capture some portion of the extrinsic value as we go along, and then also if the market pulls up. And we are using leverage that's way less than 1x. For example, our leverage here will be, somewhere around 0.6x. So that leaves us plenty of buying power, plenty of capital to take a huge hit if the market goes down. Actually, we are hoping the market goes down. Every time we put this original trade on, we hope the market dives, 5-6% if possible, and then we place another trade, and that's our alpha trade. Sooner or later, the market will come back to us here. We just have to make sure that we are okay with buying power and everything else to make sure that we can wait for that. But we do want to place a second trade when the market drops. But anyhow, let's see if we can play with this a little bit. So I don't know. Let's try and be slightly greedy here. It's unlikely that we'll get that close, but we can start there and can go right here, then replace the order, go down, work our way down, and the market is also moving away from us a little bit. So we're going to replace this one, go again here, and it's still this is always the case with the MES. It's not very friendly with the liquidity, but we were able to close it here for 60.25, and let's record that. So we're going to start here with a brand new trade one. We're going to do this, and let's record the strike, which was 58.30, 58.30, and we collected 60.25, We did one of those, and that's it. So we collected 300 here. And you can see the record keeping is also very simple with this strategy. That's basically all we do here. We just take a note of the strike. Now, as the time goes and as we put on some more trades, we'll be adding other things to the spreadsheet, like assignment, because sooner or later we'll take some assignments. We want to make sure that we record that, but I'm not sure yet what info will I be doing for that. So I'll leave it right here for that, and I'll adjust that as we go. And the same thing goes for covered calls, because every time we get assigned and then later on are able to sell calls against that at or above the strike price, then we'll start selling calls to collect more premium as we wait for the market to rebound and pass our strike. So that's on that. Let me see. Nothing else. Oh, I need to just correct. Well, this is very close to the what is it? To 48,035. 48,035. And you can see right here that our current leverage is 0.61. And then let me just record the spot price. This is good for analyzing later on. Spot price 57.93. 57.93 and 57.93. And I also want to record this here. These are some formulas here to help me figure out where my final naked put would be if the market starts pulling back. And I want to know where we started, and then I can figure that out. But I'll show you that some other time when we actually have to do it. And obviously the spreadsheet is available as well for the premium members of the Discord group, and link is in the description below. And let me just see, John has a question. For the first stage in the money put, what is your target delta when you roll? So the initial target is roughly 65. Let's go, where are we? Right here. So roughly 65%. The trade plan calls for somewhere between 60 and 70, with 65 being a default. And then we would probably move a little bit higher in a low VIX environment and a little bit lower in a higher VIX environment. That's for the initial one. And then for the roll, well, it's no longer about delta as much as it is about being able to roll, because if the market goes way down, we might not be able to roll just 1 week and still collect enough premium to keep it going. So we might have to go for 2 weeks, but we wouldn't want to lower the strike. If we can't roll at a reasonable duration and a reasonable delta, then we will just take assignment and just wait until the market comes back up, and then we can sell the naked puts. Does that help? Yes, thanks. All right. Welcome, John. Anybody else, guys? Any questions? If not, then yeah, I think I covered everything. It's just super simple and straightforward. Most of the times, once this is gone from here, most of the times we'll have 1 or 2, maybe 3 naked puts, but and we don't really even have to keep track of the buying power usage as we go. Only, you know, if it so happens that we are extended and the market is really going down, then we can keep an eye on this. But for right now, we're using 3.1%. So like there is nothing to worry about there. Market can go down 20% tomorrow. We don't need any hedges or anything. And you know, the more I think about those hedges and black swan hedges and stuff, the more I am the more I am sure that it's just if you start doing those hedges, then you have to pay for them. Then you have to put more trades on to pay for them, is one way or the other, or more risk. And then you start chasing your tail, and you're just blowing up and everything. And then you don't even know if those hedges will help you, because a lot of people back a couple months ago, well, a month ago, beginning of August, a lot of people had hedges on and thought they were safe, and then those hedges didn't get triggered, but didn't get triggered enough, or you couldn't get out of them and things like that. So I figured I want to put a strategy, make a strategy such that I don't need any hedges for the most part. So as it is right now, I don't need any hedges. Market can plummet. I don't really care, but I do have to worry about hedges if I already have 2 or 3 trades on and the market continues to go down. Then there is a point at which we would start putting hedges on demand, but not permanent hedges or no rolling hedges, none of that. Nice, lean, clean, and simple. And we can do it once a week, let's say on Fridays, just do it on Fridays, or we can break it into maybe two trades per week. We'll see. I don't know. Right now we have, because it's Monday, we put it on Friday, then we'll take a look on Friday, see what we're gonna do. All right, guys, that's all. Have a fantastic rest of the day. Bye.